Chicago and welcome Oliver Slope, Blue Line Futures. He's joining us now from the edge of the trading floor. Wow, what's the talk of the trade there on the floor? I bet I can almost guess what the key topic is.
Well, risk off is the name of the game, and this started to pick up at the back half of last week's trade with the development of the coronavirus, and that obviously spreading through multiple countries. And obviously, it's kind of the atmosphere where you sell first and ask questions later, and we're definitely seeing that take place here in the agricultural markets. Grain sharply lower in the overnight and holding on to that pressure in the early morning trade. At some point, I think this will probably get overdone and represent a buying opportunity. But right here, right now, the money flow is telling us not to step in front of this train just yet. 375 has been the bottom end of that range for that March corn contract. This is a level that we must defend on a closing basis. A break and close below there, and funds could pile back in on the short side, potentially taking us to retest those contract lows at 365 3/4. Funds short about 70,000 contracts. We were optimistic heading into this week from last week, but again, risk happens fast, and when that happens, sometimes the best trade is no trade.
Well, on the last commitment of traders report that we got on Friday, I understand the large commodity funds were net short still by, what, 67,000 contracts or something like that?
Still net short, and that was part of the reason why we had an optimistic approach on corn after option expiration on Friday. But again, these headlines kind of throw a wrench into that plan, because over the past several weeks, there was starting to be a trend developing in that money flow. Funds buying back positions. They bought back about 10,000 contracts last week, still short about 70,000 contracts. So we were anticipating the funds to continue to buy back short positions. But again, this headline risk is something that is unforeseen, and you can't really plan on that. And when that happens, just kind of got to move to the sidelines and let the dust settle.
And I see where the funds actually flipped on the soybeans. They had been net long, I believe, and now they're net short there by 13,000 contracts.
A fairly neutral position in the soybean market, and that makes sense right around that $9 psychologically significant and really an inflection point. From that point on Friday, you can make the case for a 20-cent drop or a 20-cent pop. 20-cent pop taking us to 920 represents the 50 and 200-day moving average. The low end of that range, 879 to 882, is the August, September, and December lows. We break down that low. I imagine the RSI will come down substantially, put us in oversold territory, and represent a pretty good buying opportunity in the near term.
On the other hand, I noted where the commitment of traders report showed the large commodity funds were net long in the wheat by about 41,000 contracts, so that remains as well. We'll come back here in a moment, Oliver, and we'll take a look at our livestock trade and how we're setting up heading into the mid-session right after this.